With the recent recession, has the priority for how consumers pay their bills changed? Conventional wisdom has always said that consumers will pay their largest secured debt obligations first. For example, consumers with a mortgage, an auto, and a credit card bill will pay those bills in that order. However, a recent study conducted by TransUnion has shown that there's a new payment hierarchy. In the first quarter of 2008, the percentage of consumers that were current on their credit cards and delinquent on their mortgage surpassed the percentage of consumers that were current on their mortgage and delinquent on their credit cards. The percentage of consumers that were delinquent on their mortgages and current on their credit cards rose to 6.6% in Q3 of 2009, up from 4.3% in Q1 of 2008, where the trend was first noted. Another point of interest comes when examining consumers that are found in the lowest scoring risk segment, where the delinquency rates were even higher. When examining consumers in the lowest risk segment, for those consumers that were delinquent on their mortgages, yet still current on their bank cards, their delinquency rates rose from 19.1% in Q4 of 2007 to 29% in Q3 of 2009. So how does this new trend in payment hierarchy affect some geographic areas that may have been hardest hit by the housing bubble? In Florida and California, for example, the change in the payment hierarchy is even more pronounced. Within California, the percentage of consumers that were delinquent on their mortgage, yet still current on their bank card, rose 191% from Q3 of 07 to Q3 of 09. And for those same consumers in that same trend in Florida, that percentage rose by 143% compared to a 68% increase for the US overall. Conventional wisdom would indicate that once the economy passed through the worst of the recession, the traditional payment hierarchy would then re-ensue. However, we found that this was not the case.